very quickly. That's a decline if we were to open at these levels of another 3.3%. And remember, for the Dow, this comes after a decline of 3% on Friday, 2.1% on Thursday, 1% on Wednesday. Small moves that added together look pretty startling and stunning. S&P 500 looks like it is down by 3% as well, and the Nasdaq is off by 4.8%. All of this is playing out in Europe as well. In the early trading there, you can see that the DAX is down by 3.8%. The CAC in France is down by 4.6%. The FTSE down by 4.25%. Things really kicked off last night with the Asian markets. If you're looking at Shanghai, that market closed down 8.5%. It was down as much as 9% at points during the session. The Nikkei closed down by 4.6%, and the Hang Seng was down by over 5%. This is playing out in virtually every market this morning. Take a look at the energy complex. WTI down below $39 a barrel right now, $38.74. That's a decline of another 4.25%. The 10-year note below 2% for the first time since April, 1.988%. And this is happening just weeks before we thought the Fed might actually raise rates. If you go back a few weeks ago, we're going to talk more about that in just a moment, but check out what's been happening with the currency markets. Right now, it looks like the dollar is down across the board. Euro at 115.13. The yen at the dollar yen at 120.04. Of course, it's a very different story when you start looking at what's been happening with some of the emerging market currencies. But gold this morning looks like it is relatively flat. It was lower earlier today, but again, gold has been bid up just over the last couple of weeks.
Has there ever been a Black Tuesday or a Black Wednesday? Everybody's calling this Black Monday again. Right. What about a Black Thursday? Was there ever a? I mean, it's a Ruby Tuesday, right? It's not a. It's always a Monday.
What is Monday? People come back after the weekend.
Eagle flies on Friday.
They think about it.
Eagle flies on Friday. Okay.
Stormy Monday.
All right. One name that we talk about a lot. You hear us talk about Stan Druckenmiller, the legendary investor and hedge fund operator. Used to be Soros's. Made a lot of money for George Soros over the years on big calls, and he was at Delivering Alpha, Steve, a couple of years ago, and we've talked to you, talked to him, I've talked to him a lot.
July when you
it was a year ago, July, and talking about how the Fed should have started raising a while ago because of the dislocation, what we just talked about really with Jim Grant, that it causes things to do things that they wouldn't normally do when you artificially set prices that things get screwed up. Anyway, normally I don't quote him, but he said it's fine to quote this one. These are his thoughts today. Now all the consequences of the financial engineering will be exposed, and now the Fed won't be going until at least 2017, nor should they. The market is now going to shut down the behavior that the Fed should have shut down itself a year ago. An additional $5 trillion or so in M&A, $700 billion in buybacks at record prices. So people didn't know how many holes do you drill, how many factories you know. When you have artificial, prices being set. And this is the idea that Jim Grant just talked about too.
Where he said the Fed and what it's done has killed the metabolism for capitalism.
Slow down
the losers don't get shut down, and the demand gets pulled forward in all of these situations.
When Stan was there at Delivering Alpha, he pointed out that it was, I think he first warned in 2005 about some of the dislocations in subprime and the housing bubble, and it took, how long was that? It was 2.5, 3 years before anything. Now, people say, well, he's been wrong, because it was a year ago for Delivering Alpha. I'm worried he's going to be right.
But is the implication that he's calling for effectively a bear market that's longer term? That this is not just a week long or 2 week long. I mean, you're not going to upend the M&A market, the buybacks, all of the things that he's talking about. If we have a snapback in a week or two.
What does it mean if the consequences of the financial engineering will be exposed? What does that imply? That implies that
it means that, and everybody who has been a supporter even of Fed zero interest rates or QE has argued that there are consequences of it. It's not a free lunch.
You don't want a 2008 consequence of it. You don't want something worse than what they were trying to...
Ultimately, the conclusion has been among most monetary policy experts that the benefits outweigh the cost. And you have to ask yourself the question, given the economic performance we've had, where would the free market set interest rates? And I don't think they would have set it a whole lot different from where the Fed did. In fact, there's a good argument, and a guy like Narayana Karchalakota, who's a smart guy from Minneapolis, would argue the Fed should have done a lot more. That the fiscal stimulus was too low.
It's fiscal.
But the lack of fiscal was a big part of what the Fed
All right, guys, we're in a global market reset.
They delayed.
This is pretty much what we're going to start talking about, a global market reset.
Much quicker and much more and much more aggressively. Let me just